Okay, well, we will go ahead and get our Commodities 201 webinar started. We appreciate all of you for joining us. I wanted to thank Scott in our office here. He is going to join us today and help us talk a little bit about commodities and the Commodity 201. Will especially be helpful when we get to wheat. We're going to talk not specifically to help you understand the wheat market, but wheat is one of the examples that we will go through today. And Scott always gives me trouble in the office here that I don't care about wheat, and well, partially that's because I don't have to because he's here. So thanks for joining us, Scotty.
We all care about wheat because we like baked goods.
There you go. There you go.
Especially donuts.
Commodities 201, where this all started, we've got several different what we call 101s and 201s for different commodities. We talk about veg oil markets, and we have a wheat 101, and we have a dairy 101, and others that we've done on these free webinars before. And one of the pieces of feedback that we always get when we do those is, well, gee golly, this is great, but I'm just new at this. Can you start at a lower level? And that's where the Commodity Basics webinar that we did actually a few months ago started. It was that request. And then some of the additional feedback is, well, that's all great. And that's been very, very helpful. But how about now taking a next step? And so what we're going to try to do today, what the objective of today's call is to try to take you a little bit deeper into the world of commodities to help you understand them a little bit better. We're going to talk about kind of commodities. We're going to talk about the futures contracts and how you might use those to manage risk, although that too will be a whole nother webinar, probably a hedging 101 at some point. But then we're also going to delve into the differences between the futures contracts and the actual physical commodities that you might buy and why the prices might be a little bit different. And then we're going to try to tackle the USDA supply-demand balance sheet. I want to not show you necessarily the specific commodities that we're talking about here, but more than anything to use those as an example to try to help you understand and look at supply demand and how the USDA and the analyst community reports it and how to make sense of some of that data. So that is a bit of a tall order to get done here in an hour or less. So let's just, if we can, let's just go ahead and get after it. Like I said, we're going to talk about futures contracts. What do we use them for? We're going to talk a little bit about the basics and the exchanges and why they started. And then we're also going to talk a little bit about why they're important. I think there's a tendency, I've seen people in this industry say, well, isn't this just a big casino? Isn't this just a big speculator thing? And the answer is absolutely not. I'm not telling you that there's no specs in the market. Specs are a good thing to a point. But commodity futures are a derivative or financial instrument that are actually used to help offset and manage price risk. Think of a farmer. Farmer's planting a crop. Mother Nature willing, he's going to grow a crop, and he has price risk. He's already paid for his fertilizer. He's got his diesel fuel. He's got a ton of money invested in land and equipment, and he's trying to manage that and generate a return. And in the very volatile commodity markets, the use of these instruments can be very, very helpful. So we'll talk a little bit more about the contracts themselves and how you might be able to use them. We'll talk a little bit about futures prices, why those are different. As I mentioned, Scott's going to help us a little bit here talking about the basis. Many of you buy commodity items, but for example, wheat flour that Scott's going to talk about. Well, flour is not exactly wheat, but it's made out of wheat. There are some other components and co-products that come out of it. There's this basis thing that he's going to talk about with a little bit of my help. So we'll try to take you through that as well. And then, as I mentioned, we're going to get into the supply demand of it. We're going to get into a balance sheet. We're going to look at a USDA balance sheet from their last WASDE, which for those of you that remember from our last call, WASDE stands for World Agricultural Supply Demand Estimate. USDA gives us these on a whole host of different commodities every month. So we're going to look at one of those. I'm going to tell you what's important. We're going to talk about the different pieces of it so that you could use that as kind of a backdrop or an example for looking at maybe the commodities that are most important to you. So what's important? What should you be looking for? And then we're going to kind of get to the bottom of that. We're going to talk about stocks to use and how that can be a bit of an indicator or a proxy for what prices you would expect. Now, as you might expect in the commodity business, it is not an exact science. A given supply-demand balance estimate may or may not yield exactly the same price as it did the last time it happened, but there are reasons for that as well, and we'll talk to that. And then we're going to finish up talking about just a couple, again, as examples, but a couple long-term trends. Now, there are macro issues that we've all experienced in the commodity market. Matter of fact, the two trends that we're going to talk about here are actually older than you and I are in this business, Scott. We're going to talk about some things that have been going on for longer than the 75 years that you and I have been in the business. I guess you about 35 and me about 40. So the reason we're going to mention those is it's always important to kind of take a step back and look at not just the U.S. picture, but the global picture, and even beyond the global picture, what are some of the broader trends that might be influencing the direction of price. So enough about setting the table here. Let's just go ahead and dive right in here and get after it. So what is a futures contract? Well, that's kind of a legal definition. A futures contract is a legally binding agreement to buy or sell a standardized asset, or in this case, a commodity, on a specific date or during a specific month. Typically, futures contracts are traded electronically on exchanges such as the CME, which stands for Chicago Mercantile Exchange, which is the largest futures exchange here in the US. So I guess a couple things to touch on there. Standardized asset is one of the phrases. The way futures exchanges work is the actual item that is traded is identical. You're not saying, well, mine's a little different than yours, and so therefore mine should be a little bit of a premium. That happens in the cash market. Different suppliers might say, well, my service is better, my quality is better, therefore I would command a little bit different price. When it comes to the futures contract, the instrument itself is standardized. The delivery system is standardized. The lone variable is the price itself. So that's basically how the exchanges work.
And it needs to be that way.
Yeah, it does. It does.
So that your price discovery is true.
Yeah, exactly. It's you basically standardize all variables except the price variables. That's absolutely true. Hopefully, some of you that attended our Commodity Basics webinar did your homework. If you remember, your homework was to watch the movie Trading Places. We had a couple clips from that movie in the last one. No clips today. I apologize, but you should, if you haven't, go back and take a look at that movie. I'm just going to answer one of the questions that we get asked a lot. Because when you're kind of new to futures, a lot of people don't know that you can actually sell a futures contract that you don't actually own. Now, that seems highly speculative. I'm sure there are those on the call rolling their eyes and saying, well, that just means it's not legitimate. It's not that way at all. A futures contract is just that. It is a binding agreement to buy or sell. Well, if you think of a stock, I suppose you can short sell a stock, but that is speculative. You have to actually own something to sell it. If you have a car, can't sell a car without owning a car. These are different because think about it from a price risk standpoint. If you're a farmer and you're out in your field today on your tractor planting a crop of corn, you don't actually have the corn yet. Mother Nature has not allowed you to have the corn yet, but you have every reason to want to sell that corn in a future period, i.e. harvest or beyond, and you want the ability to have price transparency to see what that price is going to be and actually be able to contract, at least through the futures exchange, a price to sell that for, to manage your costs and to manage your price risk. So that's why these instruments work that way. I know it seems a little bit odd, but that is the way they work. Let's keep moving. Let me give you a little bit of a history here. And if you notice, I'm not going to read all the verbiage to you necessarily, but these exchanges started back well over 100 years ago. And I've read stories of the genesis for this, is that a farmer is going to harvest a year's worth of grain this fall, a year's worth of grain. And so what does he do with that grain? Does he sell the grain at harvest? Does he store the grain? What does the market look like out forward? And for a farmer to help make that decision, that's where this price discovery came in. For example, this might inform a farmer as to whether he's better off selling at harvest. Why would he sell at harvest? Well, if the price is well above his cost of production and he has a nice profit, that might be a reason to sell. If he doesn't have a bin to put it in and keep it, that might be a really good reason to sell because there's no place to put it. But one of the other things that this futures price transparency informs is storage. Somebody's got to store the crop. And people don't generally work for free. I don't. You don't often, from what I can tell. And so if a futures market that is trading for different months into the future, if the price is higher in the future, a farmer may decide to hold his crop today because the relative price to sell it a month or 2 or 5 from now is higher. So the market also will gauge storage and pay different entities, farmers, grain elevators, and what have you, to store those crops. And so that is kind of the reason for it. You can see that pretty building on the left. That used to be the tallest building in Chicago. That's actually 141 West Jackson Street. That's where, I don't remember what floor it was, but on one of the floors up there is where all the different commodity pits. You see the picture in the upper right-hand corner. Pre-electronic trading, back when Scott and I started in this business, someone asked me at one point, so what are the pits like? What are the commodity trading pits like? And I said, well, it's kind of like chaos. It's a bunch of grown men standing in a hole in the floor yelling at each other. However, it seemed to be an incredibly efficient process. Actually kind of cool. It's not nearly as antiseptic as the electronic system, but I do suspect today's electronic system does probably work a good bit better. But at any rate, that's a little bit of the history of the exchanges and actually why these instruments have come into place. Before we get started here, maybe a little bit of a glossary of terms here. I don't want to get too tangled up in the details of it, or we'll never get done, and people might be going to sleep, and we don't want that. We'll want to try to keep it interesting. So every futures contract, and by the way, there are multiple futures contracts over the course of the year. Delivery month symbols, we'll get to that here in just a second, but there are 12 months in a calendar year. Not every commodity has 12 futures months. Some of them do. A lot of the energy contracts, you could actually trade natural gas futures for probably June of 2 years from now.
You could trade crude oil, WTI crude oil for like 10 years.
Yeah, I wonder how much liquidity is out front.
Yeah,
there's tremendous amount of time out front. You might say, well, how in the world could you know multiple years out? Well, if you think about it from the perspective of an energy producer, somebody that is exploring for natural gas and petroleum, and then they got to dig it up, and then they got to process it, that is a multiple year exercise requiring tens and hundreds of billions of dollars to invest. Mm-hmm. And so therefore, the ability to lay off that risk out in future time periods is part of really how a lot of these industries work. So there's multiple delivery months. We'll talk a bit more about that when we get into it. There are different delivery month symbols. We'll talk about those. It's not completely random, but it also doesn't
pretty close.
It's pretty close to random. It's a question I've been asked multiple times in my 40-year career. Why is the symbol for January F? And I guess the best answer is,
I don't know.
It just kind of is, right? Yeah. Somebody decided that's what it is. But again, more on that in a little bit here. We'll talk a little bit about the delivery mechanism. Again, we don't want to get too far off into the detail ditch here, but you might say if these are derivative instruments, if they are financial instruments, why do they have anything? Why is a corn futures contract, why does the price of that track with the actual physical trade of corn? The answer is often a delivery mechanism. In other words, if the cash market, the actual market for physical truckloads and rail cars of corn strays too far from the futures price that the people trading in these instruments say it is, there's actually a delivery mechanism. You guys have probably all seen or heard the joke about the guy that forgot to liquidate his live cattle futures and a truck of animals showed up at his front driveway. Well, it doesn't actually work exactly that way, but kind of to a point it does.
Well, and remember, you said we don't want to get too deep, and we talked a bit about the history, but remember back in 1848, 1850s, that was the market. And the the Board of Trade and that futures exchange was designed primarily as the place to take those goods.
The first farmers market.
The first farmers market, if you will, was actually located in Chicago, Illinois. And so it was a place for delivery of live cattle and hogs and corn and wheat.
But that is an excellent point. And then the futures contracts kind of grew out of that.
Correct.
It was a way to actually hedge and offset future price risk. That's a great point. But at any rate, that delivery mechanism, without getting too far off into it, is that mechanism of the contract that makes sure that the actual physical market and the futures market prices stay pretty close together. First notice day, that is part of this delivery mechanism. Technically, it is the last trading day of the month prior to the delivery month. So if you're trading July corn futures, the last trading day of June, which I believe is the 28th, is the first day that you can actually notify the exchange that, hey, I'm actually bringing you corn instead of liquidating my contract, my futures contract. Now, I will tell you, I didn't look up what the actual percentage is. But every time I've looked in the past, it's 98, 99, 99+% of all futures contracts are liquidated. They're not actually settled through the delivery mechanism, but know that that delivery mechanism is there, and it is actually so efficient that you typically don't have to deliver much product to actually keep the prices in check. Let's talk briefly about margin, and then we better get after it here. We're not going to have enough time. To buy or sell a futures contract, you don't actually have to put up all the money. If you buy 100 shares of a stock that's cost $50 a share, you got to come up with 50 grand to buy the stock. Not so much in the futures market. You are simply controlled maintaining an equity stake. Initial margin is what the exchange requires that you put up. Typically runs between 3 and 12% of the value of the contract. For example, a contract of soybeans, about $12 a bushel. 5,000 bushels in a contract, that's 60 grand worth of soybeans. If you're a hedger, i.e. a farmer or a soybean crusher, you can actually, I think the margin requirement on that is about $3,500 right now, something like that.
35.
Yeah. Yep. And then maintenance margin is the amount of equity that you have to maintain. So let's say you put up $3,500 and buy a contract, a soybean futures. You buy it, the price of soybean drops 50 cents tomorrow. That means your $3,500 worth of margin today, you only got $1,000 equity stake. The exchange is going to say, look, you need to maintain a minimum of $3,000. You got to send me $2 grand. That notification that you got to send in $2 grand is what a margin call is. Right. So you've got to maintain your equity stake in these things, but that's a little bit about how they work. And like I said, probably enough for this particular part of the call today. So let's talk a little bit about symbols. Let's talk about understanding your quote screen a little bit. This is the list that we used in the last webinar, but you can see I've put some symbols back here on the back of them. Now you can see corn up here. The symbol for corn is ZC.
Well, let me throw this in right at the beginning. In our program that we use, which is called QT, it's ZC. There are other systems that Reuters has a system and DTN has systems, and in other systems they may be
slightly different,
shown in a different manner.
Well, that is an excellent point. Although if you go to the Chicago Board of Trade website, that's what it'll be. That
should be that way.
Now, back in the olden days when you and I started, corn was just C.
Was just C.
Made perfect sense. Well, When they started electronic trading, they didn't like stop trading in the pit on Friday and start the electronic trading on Monday. Believe it or not, they traded the electronic platform and the pit side by side for years.
Yeah, years.
We would actually watch the quotes of both. Now, needless to say, they stayed awfully close together, but C was the pit traded corn and ZC was the electronic traded corn. You can see a lot of Z's on the front of stuff up there. For whatever reason, it has kind of stuck, but there is a handful of symbols. I mean, there's not going to be a test, so we don't need to memorize that. But we wanted to kind of take you through a little bit about what you're looking for, what you're looking at when you're looking at a quote screen. The first 2 or 3 spots to the left is going to be your commodity. In this case, it's electronic wheat, which is the only wheat right now, ZW. Showed you on the prior one. The next spot is going to be your month. Now, again, here's the month. Here are the 12 calendar months, and here are the letters associated with them. Now, generally, the months run chronologically from January to December, and I suppose alphabetically, they do run chronologically between F and Z, but I'm not sure who decided that F was January. Again, it's not important, but there's your cheat sheet. And that gives you an idea of how to look at what you're looking at. So let me show you, this is actually a screen grab off of our QT quote system. Now, if you look here, we got a cheat thing right in the middle. We have an actual instrument description. Most quote screens will have that. However, most of us are watching a single screen. We're trying to cram as many commodities for as many months out into the future as we can. And if you can imagine, they're the top one, soybean oil, right? Well, there's 8 or 9 of those that are trading. So I'm trying to watch all the soybean oil, all the soybean meal, all the beans, all the corn, all the wheat, all the other stuff. You get so many things crammed on your screen that this is usually the first thing that's go. What's the old saying? Something's got to go. That's usually something that's got to go. And so you learn to look at the symbols. So let's go back to wheat. I was just talking about wheat, okay? There's your ZW, there's your wheat. There's your U for September. So you back up there and you see U as September. And then the last 2 digits is going to be the year. That's 2024. So the other thing that I wanted to talk about briefly on this screen, wanted to point out, is that the unit of measure that you are looking at depends on the commodity that you are trading. You also, the use of decimals seem to be some degree random with the exchanges as well. They will always report soybean oil, which is the top one there with the decimal in the middle. But you just have to know that that is $0.4566 per pound, or about 45.5 cents a pound. Why they put the decimal there, not exactly sure. Soybean meal, $75.30 a short ton. And this is what takes me to the grains. Now, this is also something that is, I would say, more tradition. But you can see this 12.37 and then the little caret and a 0. That is read as $12.37 per bushel. Well, you might say, what's the 0? And why does the corn have a 6 behind it? For whatever reason, back in the day, they started trading grains in 1/8 of a cent per bushel. That 6 is read as 6/8 of a cent, commonly referred to as 3/4. Okay, so you get the idea here. The wheat, that's $7.22.5. Kansas City wheat, $7.43 3/4. Just simply know that you have to know the unit of measure if you're going to have any hope of making any sense out of this. The other thing is when you set up a quote screen, typically this is kind of how you set it up. This is what the last transaction, the last trade reported. This is the change on the day, what it's up or down from the prior day. And then a lot of times we'll look at a high or a low in the marketplace. So hopefully that made some sense to you. Now let's get into the basis side of it and a little bit of the pricing side of it without getting too far off in that ditch. And I think, Scott, you had the best slides here for an example. Why don't you kind of take us through why wheat's not wheat everywhere in the world and the same kind of wheat?
Well, yeah, how much time do we have?
I'd like you to be done in 4 minutes.
Yeah,
No, I'm
okay.
kidding.
The thing about wheat and wheat basis, and remember, we've been talking about these futures that are the traded commodity. There's a standard specification for whatever that wheat that we're trading at the CME, whether that be the Chicago contract, the Kansas City contract, or it could be the Minneapolis contract up in Minneapolis, the Minneapolis Exchange, which is spring wheat, hard red spring wheat. And so the difference between that futures price that is traded in Chicago, and we discover that price between the buyers and seller there, and whatever it's worth, let's say in Omaha, Nebraska, is what we call basis. Okay. Now, the first thing, or the biggest portion of that basis, is made up of transportation costs. Okay, there are costs involved with getting that wheat from the farmer to the market or to the mill itself. And then there's also transportation costs going away from either a terminal market, let's say, to export, or if it's going from a mill being made into flour, and then there's outbound freight going to.
So where it actually exists is part of the difference.
Certainly. There are storage costs. Dave mentioned earlier, is this grain going to be put in a bin someplace, whether it's on the farmer's farm or if it's going to be put up at an elevator someplace or at a mill. There are costs involved with that elevation. It takes time and money and electricity and power to move that grain and put it up in a bin. There's obviously interest and insurance costs on top of that. We have supply and demand up there, and that again has much more to do with what's going on locally or regionally. Case in point, something that we should all know, especially if you're a flour buyer. 2 years ago, there was a war that began in Ukraine, and all of a sudden, the supply of wheat out of the Black Sea was very much in question. And the basis for that wheat went through the roof because of that anticipation.
Futures did as well.
We found today that the demand is really not changed a lot, and we have been able to prove that we can still access that supply out of the Black Sea. And so that has normalized quite a bit. And the last thing that Dave mentioned is quality. Now, quality can mean a lot of different things, but the first thing I would say when it comes to wheat basis is at the bottom there. We have 3 different classes of wheat. HRW, which is what we grow in Kansas. That's our bread flour for the most part, 12% protein. HRS, hard red spring wheat, that's the stuff that's grown in the northern plains and in Minnesota and Canada. It's a harder variety of wheat. It's higher in protein. And then we have SRW, soft red winter wheat. And we see here 2 examples, one being milling quality. That would be the stuff that is of the higher quality that we would go take that to a flour mill and turn it into flour. We don't want low quality soft red winter wheat flour to make cake, right? And then we have
cookies.
Cookies are good too. Export quality. Now that is a little bit lower quality. That's stuff that's going to go out in the export channels. Most of the time here in the States, it's either going to go off the Gulf or it's going to go off the PNW. So those are the bigger examples, I think, when we're talking about wheat basis. But then within quality, we can also talk about not only protein, but then also milling characteristics come into play too.
Yeah.
Now that's another deep dive that we don't need to get into.
When we talked about futures contract, remember we said it's a standard contract for a standard grade?
Mm-hmm.
But when you get into milling and you get into specific specifications that you might have for your particular flour that your company uses that you buy, well, that might be a little bit higher than the futures. Therefore, that's part of also what makes up that basis. It adjusts for those differences.
So when we talk about flour pricing, you're not actually going to use a wheat futures contract to hedge the flour that you buy. It's 2 different things. Now, flour is actually made from that wheat, And they hold a very, very high correlation. And that's why we would use it as a hedging mechanism. But when it comes to the actual flour pricing itself, we typically use three main components. Futures, as we've talked about quite a bit, basis that we just got done talking about, and mill feed. That is a byproduct of the milling process. You take the wheat, you grind it up, you get flour, and you get this other stuff.
It's animal feed, basically, right?
Most of the time, it's just animal feed, okay? And it's not quite a third of what comes out of the milling process. And because that is a quote unquote byproduct and the miller can get something for that other stuff, they will credit back to the flour buyer in their price.
Let's see the formula.
Sure, let's go to the formula. There you go. So without rolling through each and every one, you can see at the top, whether you're a flour miller or you're somebody trying to figure out what my flour should be worth. And this is an older example, obviously.
Clearly at $5.
$5 Kansas City wheat. But let's say it's a 12% protein at $1. That would be pretty cheap today too, quite honestly. And so your wheat cost, Bob the mill, is $6 per bushel. Your yield, flour yield conversion typically is 2.3. That's kind of a rule of thumb.
2.3 bushels to get 100 weight of flour.
Exactly. And so you're going to get to $13.80 per hundredweight of just your wheat cost. Now we credit back to you, as I mentioned, the mill feed credit, $100 a ton. So we convert that to dollars per hundredweight. We take that $1.90 off of the $13.80. And so now your raw flour cost at the mill is $11.90. Now the miller's going to want to get paid, and he's going to have to pay for his outbound freight. And then there's any treatment, packaging, pallets, and all that other fun stuff. And you get to the bottom line there, $20.15 per hundredweight. Now, the other thing I want to make clear here is, remember, we're using the wheat futures as a hedging mechanism. If you take just that $5 wheat number there, it ends up being about 60 to 65% of the total cost of your flour is located in Kansas City, or in this case in Chicago.
But I think the futures actually account for nearly 90% of the price volatility and the changes of your flour.
Exactly.
That's why you can use these futures contracts to hedge. Back in my my prior life, my last job, did a little statistical analysis, and I was buying all the refined oil, soybean oil for the company I work for. About 92 to 93% of the price changes that we experienced in the refined oil that we bought to make the various food products that we made was represented in the futures alone. The other 7 or 8% is the basis and the freight and the milling margin and everything else. And the message here today is not that you should component buy your flour this way or you should component buy your oil. The message here today is just simply to show you the difference between the raw commodity and the item that you might buy, the pieces that make that up, so that we can point out that the futures is the biggest thing that you got to worry about. That is the biggest cause for the price changes that you experience. Like I said, refined oil, 7 or 8% is everything else. And these are commodities that historically experience better than 20%, and in many years, like the last 30 or 40% annual volatility just in the price change of the futures alone.
Right. So if you can get your futures procurement right, you've just about got things
right.
Now that's not as easy said or done as said. So
yeah, we would get in these cost savings projects at my last place of employment. And it's not that those aren't important, but you can't save enough money if you mess the futures part of it up. That's where the money is if you're the commodity buyer. So I guess that's probably as close as we'll get to advertising for the day. A similar story on soybean oil here, but I think we have probably belabored at that point. And I think in the interest of time here, we wanted to get into the supply demand side of it. Now, you remember this word cloud probably from the Commodity Basics webinar that we did. And the message here is that when it comes to analyzing commodity markets, there are a lot of moving parts. Again, that's probably as close as I should probably get to a shameless plug as well. But There are a lot of variables, and I think one of the points that I wanted to make as we start looking at commodity markets here a little bit is it seems to be daunting. It seems to be that there are a lot of variables, and I'm not going to lie to you, there are. To make matters worse, sometimes how important a particular variable is changes from time to time. Perfect example of that is July. If you're growing corn, is probably the most important weather month of the year because it's going to be how the weather is. What Mother Nature gives us in July is going to be a huge input, not the only input, but a huge input as to how good the corn crop is that year, the big S side of the supply demand balance sheet. So there's a lot of different variables, but I would just urge you, continue to study, continue to watch, and your brain will just almost start to figure out which commodities and which variables are important at different points in time. So let's go through a little bit of the math, a little bit of what the USDA tells us every month. This is the May WASDE. This report came out from the USDA a couple weeks ago. And you can see kind of a standard format. This happens to be corn that we're looking at here. The USDA is typically going to give you 2 or 3, most of the time 2 years. I'll get to that as to why we have 3 here in just a second. This is the 22-23 crop year. More on what a crop year means in just a second as well. But the short answer is this. A marketing year or a crop year is what the USDA calls it. For the spring planted crops, the corn and soybeans, it starts on September 1st, goes through the end of August. Wheat is different.
Right. And it essentially refers to what that crop is. It's going to, 1 year is going to equal 1 crop because we grow 1 crop of corn every year.
Right. And generally the beginning of the crop year coincides with harvest, not incidentally.
Right.
So we typically will start harvesting corn in September. So September 1 is the official beginning of the accounting year, if you will, that they used to balance. So this is the 22-23 crop year. This is the year that ended on August 31st of 23. It's up there for reference. 23-24 crop year. This is the crop year that will end on August 31st this year. This is the crop that we are currently using. So this is the USDA's soybean supply demand estimate for this crop year. Simple accounting, just like your checkbook balance. Your checkbook balance, your ending balance in April is de facto your beginning balance in May. And so pretty simple. Here's the estimate for, we're going to have about a little over 2 billion bushels of corn is what that means. The USDA is estimating at the end of this crop year becomes de facto our beginning balance for the next crop year. But that's only part of the supply. Obviously, another big part of the supply, the biggest part of the supply is the crop we're going to make. Well, heck, we're just planting it. How do you estimate that? Well, what the USDA does at the end of March, they estimate, they do farmer surveys, they look at their different economic yields, models, probably use like our magic 8-ball here, and they give us an estimate of how many acres U.S. farmers are going to plant. In this particular case, 90 million. Typical harvested percentage is just a little over 92%. This would be a trend yield. If Mother Nature gives us average weather, that would be an average yield of 181 bushels per acre. Little bit of math, harvested acres times the bushels per acre. USDA is forecasting a corn crop this year of 14.86 billion bushels. You add in a small amount of imports that come across the border from Canada typically. A few Canadian farmers on the border will plant some corn. And you can see that the USDA says that total supply available to use of about 16.9 billion bushels. So now we get to the fun side. Not that that wasn't fun enough. And by the way, every month the USDA will give us these updated balance sheets. They will look at changes in their demand prospects that I'm getting ready to talk about. They'll also start to react to weather here a little bit as we get out into the summer. If the growing season starts off particularly good or particularly bad, they may start to tweak that yield just a little bit. And then, of course, as we get closer to fall harvest, they'll actually have USDA agents, actually, we call it boots on the ground, actually out walking around, looking, weighing, measuring, counting the crops to adjust their estimates. But when it comes to the demand side, this, and again, is the case of corn, you're going to have to look for the specific demand items in the commodity that's important to you. But one of the things I wanted to point out here, you can see USDA, this says feed and residual. More on residual in a second. 5.75 billion bushels. The USDA is saying about 6.85 billion bushels are going to use for food, seed, and industrial. What is that? Think corn sweeteners, think cornstarch, think the seed we hold back to plant next year, other industrial applications. The USDA also, they measure that. They measure how much we use to make ethanol. They measure how much they export. So you have your total supply here and your total demand here. Before I get to the ending stocks, I want to back up and talk about this residual, because you always need to back up and spot the residual on any balance sheet. Every balance sheet has one. And what the residual is, what that means is that the USDA either estimates or counts, physically counts, all the rest of the numbers on that balance sheet. Any corn in this particular case that they can't account for, they assumed and animalated. Hence their feed number. Why is that important? Well, it can have ramifications later in the year. Remember, the USDA can't count the whole size of this corn crop. They are estimating it. Just like you see we got a presidential election year here, right? You'll see CNN does a poll. They say President Biden is in the lead, leading Trump by 3 percentage points with a margin of error plus or minus 4%. They didn't survey every voter in the country. They surveyed 800 or 900 or 1,000 people, and they estimate, okay? USDA is estimating the size of the crop, and once in a while they miss it a little bit. Well, this ends up being, to some degree or another, the slush fund. Now, that sounds like an inaccuracy. I'm not being critical of the USDA at all. They've got a massive job here, but you always have to figure out where that residual is on the balance sheet. In the case of wheat, it's also feed, but feed is a much smaller demand component relative to exports and food use for making flour. So you always have to know where that is. Soybean oil balance sheet, classic example. Soybean oil balance sheet, that's food use. You can't account for it, you assume a person ate it. So you always have to know where that residual is. So at any rate, you take your total supply, you subtract off your total demand, and you have an ending stocks forecast. In this case, about 2.1 billion bushels. Now, I want to talk here a little bit about stocks to use ratio. We talked on our last call about the Goldilocks zone, more on that later and how this fits into it. But this is simple math right here. You simply take your ending stocks divided by your total use, in this particular case, 14.2%. Now, what do I do with that number? Well, there's a couple things we're going to talk about. Number one is we're going to look at it and frame it up historically of, is that tight? Is that plenty? Is that not enough? Should the price go up? Should the price go down? More on that in a second. But let me give you another very simple way to look at it. A year is 52 weeks, right? On September 1st, we're supposed to have, according to the USDA, 2.1 billion bushels. That's about 14.2% of use. 14.2% of a 52-week year is the lower 7 weeks. What that tells you is that you have about 7 weeks of supply at that estimated usage as of September 1st. Now, why is that important? Well, September 1st is the beginning of the crop year. How much corn do we typically have harvested on September 1st?
Not much.
Not much. Corn harvest typically kind of gets rolling in late September and early October. Mother Nature willing, unless you're Texas.
Yeah.
If it's wet and harvest gets delayed deeper into October, you can kind of start to see here that if you have 7 weeks worth at the beginning of September, you're kind of out into the middle third week of October, and you can kind of start to gauge where the cupboard will start to run bare before the new crop comes off. The other way that we're going to look at that, well, let me talk about crop year real quick, and then I'll go to that. See these black lines here? These are when the crop year starts and stops. And basically the message for a lot of the big crops, the stuff we plant in the spring, typically is Sep 1 is the beginning of your crop year. Winter wheat, because you harvest it in June. June 1 is the beginning of your crop year there. So let's get into these stocks to use levels and what else we can use them for. So this is 12, 13 years worth of history right here. And you can see that these are tight years. They're kind of fall below the band, okay? Start getting up here above 12 or 13% of use, you're starting to get into burdensome supply. So I just showed you a corn stocks to use ratio that was about 14%, 14.2% of use. That would tell you that we've got probably plenty of corn. Now, remember, we haven't even planted the crop completely yet, much less made it, but that gives you an idea, and that's how you would look for this. Another way that we look at ending stocks is in absolute bushels, and this is wheat, okay? And one of the things that we discussed quite a bit in the office, not sure I got a perfect answer for it, but we got a pretty good answer. If you get to 15% of use in corn, you have a lot of corn sitting around. If you get to 15% stocks to use on wheat, you're out.
People are going to panic.
People are going to panic. And why is that?
Couple of reasons, I think. And by the way, what you're looking at here would be about 37.5% stocks to use. I think back in the day when the United States was the world's breadbasket, the breadbasket of the world, when we typically held 50%, in some cases more, of the world market for wheat.
Excess supplies.
Excess supplies. We weren't eating that much wheat in the United States. We were shipping it all around the world to places where they couldn't grow that much wheat and didn't have that those supplies. Today, that's a different story, I think. And so I think part of the answer to your question is we've kind of always done it that way. We've always been big stocks to use. We stored the world's wheat for decades and decades. And so there's a bit of old school mentality there that we have to maintain large supplies and large stocks to use ratios in wheat to make sure that we don't run out. I think that's part of it.
And the other reason that I've heard you mention before is just wheat's not necessarily wheat. Corn is kind of corn. Mm-hmm. Soybeans are kind of soybeans. But wheat, because of all the different proteins and the variability and milling quality, not milling quality, feed quality, stuff that you've got to blend off, there are so many different subsets that if you just look at it in total, you can kind of drown in the river that averages.
That's exactly the other point that I would have made. And we've got 5 classes of readily traded wheat in the United States, and within those 5 classes, there are innumerable amounts of different quality of those different wheats, and so that's why we have to have so much more storage of that product.
Yeah. So the point we're trying to make here isn't necessarily to make you experts in the wheat market or the corn market, but just so that you understand kind of how to look at these markets. And really, it's the stocks to use and the stocks tolerance levels that are specific to the commodity that is important to you. So that is where we were going with that. And as you might suspect, there is a relationship between price and supply. No kidding. Not surprisingly, the more we have, the cheaper prices get. There's a couple things I want you to look at here. First off, when you have ample supply, price gets pretty easy to predict. Most of those dots are pretty damn close to the line.
And they're in a nice tight pattern.
Yeah, a nice tight pattern. They're real close to the line, and it's pretty easy. When you start getting up here, and really I would say corn, the Mendoza line between tight and not tight is somewhere around 10%. You start getting here and you've got a lot of variability. That's one point. The second point is that line, as you can see, is not linear. It is logarithmic, I believe, is what you would refer to that. And here's a basic example. If you've got 2.1 billion bushels of corn that we just showed you, and that's plenty, and you find out either because of the weather or because something happened on the demand side that changes by 100 million bushels, and it either goes to 2.0 or to 2.2, well, you still have plenty. And so the relative price change for that 100 million bushel change in expectations is relatively minor. When you get over here to this part of the price range, the 100 million bushels that you just gained or lost might be the difference between making the balance sheet or breaking the balance sheet. And by breaking the balance sheet, what I mean is you don't have enough corn to go around and price has to go up to ration demand. Okay. 100 million bushels on the right side of this chart might be worth 10 or 15 cents a bushel. The same 100 million bushels when you're down below 7% of use might be worth $1.50. And so that's the other point that we wanted to make here. And then the last thing that we wanted to touch on today, and this just to try to, since we've been in the weeds a little bit and we've been looking at numbers, we want you to stop, lift your head, and back up a little bit. Sometimes commodity markets are best viewed at a distance. And there's two things I mean by that. We were looking at the US supply-demand balance, but these markets are increasingly global. Even though the US production of all things ag seems to continue to grow for the most part, the rest of the world is getting bigger, in some cases getting bigger faster than we are. And so it's a much more global market than it was when I started this business in 1983. The other thing when you step back and you lift your head is to look at some of these longer term trends. And this is one of them that has really been around for about as long as I've been in this business. That is Brazilian soybean production. Now, US production has increased in the same 4 decades, largely because of yields. We're not really planting a whole lot more acres than we maybe were back then, maybe a few more, but most of those increases are through yield, better farming practice, what have you. Brazil has found a whole lot more acres to plant. And so this has been a mega trend. Brazil was not really much of a production issue when I started in 1983. We really didn't pay too much attention to South American bean production. Boy, howdy do we today. Brazil alone produces more beans than the US. And South America in total produces a lot more soybeans than the US. So if you're just looking at the US balance sheet, in many cases, you're missing a big part of the puzzle. So this is one, just an example of one of the broader trends that you need to identify. And Scott, why don't you talk us through this one? This is kind of your domain, but things have changed a lot in the wheat market.
Yeah, and again,
I put them in the wrong order. I probably should have put older to the left. But.
Well, I don't know that it matters too much, but the point here again is maybe it would be a little bit easier to see on a line chart, but I had this made for another client here a while back, and we had these 2 pie charts. The one on the right actually is the 1960-61 world wheat share. And I just, again, took the top 4 producers in the world. You see there, the United States was at 41%. I could have picked another year when we were higher than that. And we actually, gained over 50 quite a few times. But just in terms of where we sit today, that was 41% of the world market. You see there that Russia barely made the list at 11. The EU, and there were only 15 countries in the EU back then, that was 7%. Canada at 22 and Australia at 15. Look how things have changed. So this was the 22 on the left, 22-23 crop year. We went from 44 million tons out of those 5 to now 218 million tons, and I've added a couple more to the list, just in terms of how much those countries are actually exporting. Look where the United States fell to only 10%, and I'll tell you what, we're not going to get to 10% this year. And the biggest one on the list is Russia. 21%. They are today, they were in 22-23 and remain today the world's largest wheat exporter. They're not the world's largest wheat grower. That would be China. And China remains the world's largest producer. But in terms of wheat export share, Russia's on top right now, followed by the EU. Now, again, I think they cheat a little bit. They put 27 different countries go into that number. Canada and Australia at 12 and 14% respectively. Kazakhstan, shows up just a little bit too, and obviously Ukraine at 7%. So again, like beans, I see this as a pretty big mega trend also. And why people have asked me many times, why don't we grow more wheat here in the United States? Well, because the American farmer can make more money growing something else.
Corn and soybeans primarily.
Right.
A lot of corn and soybeans get grown. Well, yeah, I mean, the message here is just simply what I said a minute ago. You got to be a little bit careful. We showed you how to look at a U.S. balance sheet, but that can't be the end of your picture. You've got to back up and you've got to look at global production. You've got to look at some of these long-term trends. And again, many of these long-term trends are hard to spot because they're the elephant in the room. They are so obvious because they've been there for so long that sometimes you kind of take them for granted. So that is what we have for you today, folks. Hopefully this was beneficial. I think Martha might be watching the chat line. If anybody has any questions, you can go ahead and type those in now and we'll take a shot at answering them. Official, here we got one coming in. When will we see 550 Kansas City wheat again?
Sometime in the future. What's Bill's all on? You never give a prediction of price and a date at the same time. And
yeah, in the same presentation that he does say that is, I think he says union trade rules.
I would say this about that. We're clearly in a time right now where wheat is driving the bus in terms of price discovery. It's leading all the commodities. It doesn't get a chance to drive very often. And so when it does get a chance to drive, it does some crazy things. We're up 30-something% from the middle of April in certainly in Chicago and Kansas City. And so I would say that we're going to have to be patient. I'm still bearish long-term corn, and I'm still bearish wheat. We still have to get the crop harvested, and we still have to get the corn crop planted and grown. But if all of those things happen, I would say it's not outside of the realm of possibility to see Kansas City trade down to $6. Maybe poke its head into the $5 range, and certainly Chicago down into the $5 range too.
But you got a lot of things go right at this point.
Yeah,
otherwise.
Got to have a lot of things go right. And again, sooner or later, somebody's going to kick wheat out of the driver's seat and tell them to get in the back seat and shut up again.
Yeah. Well, that's probably something else to kind of point out. Since we're talking about commodities, 2 words that I've learned not to use in this business are always and never.
Always and never.
And we'll end it today. Hopefully.
Real quick, I was just going to say, if you think of another question between now and the next time we talk to you, don't hesitate to drop any one of us a note. I'm sure you probably got the invitation from Martha. If you send a note back to her, she will forward it on to us, or drop any one of us a line, or give us a call.
Yep. And thank you again for joining. Take care and be careful out there.